Hello everyone, and welcome to the final unit in our financial management series. Myself, Gokul. I'm working as an assistant professor in the Department of Master of Business Administration in Muthukumaran Institute of Technology. Today we begin Unit 5, Working Capital Management. In Unit 4, we have covered dividend policy decision, how firms distribute profit to shareholders. Now we turn to the short-term financial management of the firm which is working capital management. This is part one. We will cover the foundation of working capital management. In this first part, we will cover importance of cash and working capital, meaning and definition of working capital, concept of working capital, element and objectives of working capital, classification and factors affecting working capital, methods of estimating working capital. Let's begin with why working capital matters. Cash is the lifeline of the company. Companies need enough cash to pay wages, salaries, and accounts payables. Key insights are maintaining sufficient liquidity and adequate working capital is a must to ensure the survival of the business in the short term and the long term. Critical warnings are even a profitable business may fail if it does have an adequate cash flow to meet its liability as they fall due. Understanding a company's cash flow health is essential to making investment decisions. A good way to judge a company's cash flow prospects is to look at its working capital management. Thus, working capital management has become a very essential part of the business concern. The meaning and definition of working capital. Working capital refers to the cash a business requires for a day-to-day operation, specifically for financing the conversion of raw material into finished goods, which the company sells for payment. Definitions by the experts are Weston and Brigham. Working capital refers to the firm's investment in short-term assets such as cash, account receivable, inventories, etc. Second, Medbaker and Malott says that working capital means current assets. Then finally, J.S. Mill defined working capital as the sum of current asset is the working capital of the business. So the working capital management refers to the management of the level of all these individual current assets. Concepts of working capital. There are several related concepts. Working capital refers to the company's current asset which includes cash and equivalents, account receivable, and inventories. Then cross working capital, the total investments made in the current asset. Then net working capital, the difference between current asset and current liability. This is a measure of liquidity. Then working capital management, the deployment of current asset and current liability efficiently to maximize short-term liquidity. Then finally, working capital policy, the strategic approach to managing working capital. The need for working capital. The need for working capital management arises from two considerations. Number one, existence of working capital is imperative in any firm. Fixed asset can be used to their optimal level only if supported by sufficient working capital. Then second, working capital involves investment of funds of the firm. Poor management can waste resource and reduce profitability. In other words, you need working capital to operate means, but holding too much ties up capital that could be used elsewhere. Then elements of working capital. Working capital consists of five key elements. Cash, cash inflows and outflows need to be monitored carefully with the proper budgeting and forecasting to achieve the required balance. Second, receivable, amounts yet to be received from debtors. These needs to be monitored and checked regularly for timely recovery. Then inventory, stock of finished and unfinished goods, which means work in progress. It should be maintained at a particular level to meet the firm's needs, not too high, not too low. Then payable. Accounts payable should be regularly checked, not only for working capital requirements, but also for the firm's goodwill. Then finally, expenses. Certain outstanding expenses the firm has not paid reflected on the capital. Example, accrued salaries, accrued bills. Objectives of working capital. Working capital management has two primary objectives, which often conflict profitability, which includes the firm's ability to generate revenue over and above all costs. A firm is profitable if revenues are consistently higher than cost. Higher profitability often means taking risk with higher liquidity. Then, second, liquidity. A company's ability to pay its bill as they become due. For an asset, liquidity implies convertibility to cash without losing value. It has two dimensions, time and risk. Time, how quickly it will happen, and risk, certainty of value, the trade-off. More liquidity means less profitability, less liquidity risk in insolvency. Finding the right balance is the essence of working capital management. The classification of the working capital as shown in the screen is classified in several ways by type, gross versus net, by time, permanent versus temporary, by component, cash, receivables, inventory, payable. We will explore these dimensions throughout the unit. Then factors affecting composition of working capital. Many factors affect how much working capital a firm needs. Nature of business, trading firms need more, firm needs service, firm needs space. Nature of material, perishable or bulky material affect needs. Third, process technology, longer production cycle need more working capital. Fourth, nature of finished goods, custom product may tie up capital longer. Then degree of competition, more competition may require more credit to customers. Size of business, larger business generally need more working capital. Time of production, seasonal production affects needs. Then rate of stock turnover, faster turnover reduces needs. Buying and selling terms, credit terms from suppliers and to customers. Then seasonal consumptions, demand patterns affect inventory needs. Then seasonal production, production patterns affect raw material needs. Then methods of estimating working capital. There are four main methods to estimate working capital requirement. First one is conventional method, matching of cash inflows and outflows. Limitations are ignores the time value of money. Operating cycle method, which includes debtor, stock, and credit minus creditors. It takes into the account the length of time to convert cash to resources to product, to debtors, to cash. Then third, cash cost technique, working capital forecast on a cost basis, taking profit and loss items into account. Fourth, balance sheet method, working capital forecast based on various asset and liabilities, taking balance sheet items into account. Each method has its strength and is suited to different situations. Interdependence among component of working capital. The component of working capital, cash, receivables, inventory, and payable are highly interdependent. Changes in one affect the others. For example, offering more credit to customers may increase sales, but also increase the need for cash to fund operation. The fundamental conflict in working capital management is between liquidity and profitability. Liquidity, its ability to pay bills, keep sales coming in, keep customers happy, play it safe. Profitability means size of earnings after taxes. The trade-off, high liquidity equals lower profitability. Second, higher profitability gives higher risk of insolvency. The finance manager job is to find the optimal balance. That concludes part one of Unit 5. We have introduced working capital management, its meaning, concepts, elements, objectives, and estimation methods. In part 2, we will explore inventory management techniques like EOQ, ABC analysis, and just in time. If you found this video helpful, means please like, share, and subscribe. Leave your questions in the comments. See you in the next part. Thank you.